Hello everyone, as we know that there was one spy who thrilled us by the name of James Bond, and now there are bonds that have been thrilling all stock market investors globally. A gradual rise in the bond yield has been creating panic amongst the investing community worldwide and has become the talk of the town. Now let us understand what bond yield is and why has it become the talk of every town. My name is Samta and I welcome you all to Valley Talk with Kalkine. I have with me Miss Hina Chowdhry, who is the Director of Research with Kalkine Group. And today we are going to discuss the hottest kid on the block, that is bond yield. Welcome to Valley Talk, Hina.
Thanks, Samta. It is always a pleasure to be here. But before we begin discussing bond yields, I think we should put a small disclaimer here for the perusal of our viewers. Any information which we provide herein is generic in nature, and before investing in any particular stock or asset, one should thoroughly understand the business model and comprehensively analyze the financial or operational aspects. Over to you, Samta.
Certainly, Hina. And on that note, the world of equity market is discussing rising bond yields. What are bond yields and why do they matter?
So bond yields, before we jump onto that, I would say bonds. I think we hope, we hope that everyone understands that these are, fixed income instruments which need to be looked at. And then you talk about bond yields. They are getting a lot of attention these days because, in the past few months, we have seen that investors are moving on to looking at what are the opportunities in this space. And there are reasons for that as well. Before I begin explaining the viewers all about the rising bond yields and the impacts thereof, let us first understand what exactly is bond. That's how I started off with bond yield and then everything around bonds and bond yields. So to put in simple terms, as I said, these are, kind of fixed income instruments or loans that one makes to a corporation or the government. One receives the principal at the end of the loan tenure, and that too if the borrower does not default. On the other hand, if I talk about bond yield, so yield per se reflects returns. So it is the return that an investor gets on the bond. So that's how these two work. And now a fall in or a rise in interest rate in an economy, they push up or down the bond prices. So the bond yields fall or rise in a situation when your interest rates are fluctuating. Since the 10-year treasury yield has been the prime focus now, let us now look at what exactly does this mean. And we keep on talking about 10-year treasury notes, etc. So these are basically our kind of loans one makes to the US federal government, and it is the only one that matures in a decade. So that's why we say 10-year. Now, it is the most popular debt instrument in the world because it is backed by the US full faith and credit clause. Hence, it is less risky. Investors care about the prices at which treasury bonds and notes exchange hands or change hands, but it is their yield that is more important. Yield, as I said earlier, is the total annualized rate of return on the bonds. So that's how investors perceive 10-year treasury notes and yields per se. Samta.
Absolutely, here and talking about that why are these 10-year yields so important, and what are the other kind of treasuries that are there in the market.
Samta, let me answer the second part of the question first. Just like borrowing money for different periods of time that an investor can have, the US government has IOUs of different maturities. Some of the securities are due in just a few days, while there are longest bonds which mature in 30 years. Now, there are a whole lot of maturities within this range that is just a few days to 30 years timeline. Moving on to the first part of the question, I shall explain the basics first. Let us understand Treasury issues debt. Now, the US Department of the Treasury, better known as the Treasury, manages the country's debt. The primary objective of Treasury's debt management strategy is to finance the government's borrowing needs at the lowest cost over time. Now, to accomplish this, Treasury adheres to the key principles, to few principles, which are three by nature: to issue debt in a regular and predictable pattern, to provide transparency in the decision-making process, then, to see continuous improvements in the auction process. Now, federal spending exceeds revenues, and when this happens, the Office of Debt Management directs the Bureau of the Fiscal Service to borrow the funds needed to finance government operations by selling securities to the public and government agencies through an auction process. As per the Congressional Research Service, most of the debt sold by the federal government is marketable, meaning that it can be resold on the secondary market. Currently, if you look at Treasury, how they're offering the securities, there are 5 types of marketable securities: Treasury bills, notes, bonds, inflation protected securities, and floating rate notes, sold in about 270 auctions per year. The small portion of debt held by the public and nearly all intra-governmental debt, which is debt held by government trust funds, is non-marketable in general. Now, investors examine several key factors when deciding whether they should purchase treasury securities, including price, expected return, and risk. Treasury securities provide a known stream of income and offer greater liquidity than other types of fixed income securities. Because they are backed by the full faith and credit of the United States, as I said earlier, they are often seen as one of the safest investments available, though investors are not, totally immune from losses. Now, coming to the 10-year yield, the 10-year yield hovered around 1.61% in mid-March, up from less than, 1% at the start of 2021, and as little as 0.31% during the market turmoil of March 2020. So this is like around 2% is the forecast for the end of this year if you look at the overall numbers. But if you look at the trends, we have noted that recently the rising bond yields, they have grabbed the attention as traders were very much focused on money markets and other short-term rates. Investors are assessing growth and inflation risk in the pandemic recovery phase, and hence the focus is there on 10-year yield, which has immensely increased lately. Now, even with rising yields, the Federal Reserve has signaled that it plans to keep maintaining the accommodative stance in the monetary policy till the economy recovers well from the pandemic.
That was quite insightful and comprehensive, Hina, and I'm sure that our viewers will now understand the current situation of rising bond yields very well. But again, coming up to that, how does this affect the whole investor in general?
So, Samta, the 10-year Treasury note yield is also the benchmark that guides the interest rates. So, the yields rise, interest rates on other debt instruments also witness a rise. So, the 10-year Treasury yield in a way indicates that, investor confidence, how it is moving in an economic growth-driven environment. Now, overall, the yield and its movement they do impact life in general. For example, low treasury yield will make home buying cheaper as one has to pay less interest to borrow from the bank. As real estate market sees strength, positive effect is also seen in the economy because it impacts your GDP, which in turn creates more jobs. So you see that the lines are connected. Macroeconomic factors drive a few things, and they are related to each other. That's what is important to note.
Moving on to the next question, Hina, I was just wondering, so, like you said, so the rising yields are definitely a cause of concern, it seems. So where do you see them from here?
So, Samta, I shall take you to some key historical rates of 10-year Treasury and then talk about the current numbers. In June 2012, the 10-year Treasury rate fell to its lowest point since the early 1800s, as investors were worried about the Eurozone debt crisis and poor job report. On July 25th, 2012, it closed at 1.43, the lowest point in 200 years. Then in July 2016, it could beat that record set in 2012 and closed at 1.37%. That time, investors were concerned about the United Kingdom's vote to leave the European Union. The yield then rebounded in late 2016, and then throughout 2017, that was the trend noted. Now, all this happened owing to Donald Trump's win in the 2016 presidential election, which set it to 2.6% by December 15, 2016. By January 18, 2019, it peaked to 2.79%. Now, below the 3-month yield of 2.46%, as investors were more worried about the economy in 3 months than in 10 years. So this was like the trend which was noted. On August 15, if you look at, if you go back and see, the 30-year bond yield closed below 2% for the first time in US financial history. So the 10-year note yield later rose to 1.83% on December 23rd, 2019. Coming to the current year, it has been a topsy-turvy ride. We have seen in 2020, the 10-year yield peaked at 1.88% on January 2nd, then began falling. It closed at a record low in Feb 2020, then it continued with the fall, setting new record lows along the way. By March 9th, it had fallen to 0.54%. That's how, the variation has been. Investors rushed to, safety in response to the uncertain impact of the coronavirus pandemic, and yield then recovered throughout the year, and it surpassed 1% in early 2021. Now, one can clearly make sense of the current state of the economy by looking at the treasury yield and its movements from 1-month treasury bill to 30 years treasury bond, in which the 10-year treasury yield is somewhat in the middle. One can clearly make how much return investors need to tie up for their money. Looking at the current situation, we have seen that the benchmark 10 years note yields were sitting around 1.67% as on 17th of March. We have noted these numbers, the highest since February 2020. And this has been quite an impactful thing. 30-year bonds were also on the move, rising to 2.428% or so, the highest since November of 2019. So yields on Germany's 10-year bonds, which are a benchmark for the euro area, they declined, to below minus 0.33% on March of 15th. On 15th of March, Italy's 10-year yield declined about 3 BPS, dipping below 0.6% on Monday. Now, these were the, things we had noted, the numbers we had noted. And owing to the $1.9 trillion stimulus push by the Biden government, the economic outlook in the US looks brighter as compared to Europe, but that optimism about economic recovery is translating into higher treasury yields, which could ripple across the economy and slow growth. So I'm just hoping, and I think we all are, that the best in the, can be seen in the coming days, and the markets come out of the difficult situation and uncertainties we have seen over a period of time. But yeah, with these fluctuations or change in trends, we do see opportunities in different ways.
Certainly, Hina, and let's hope that we do come out of these challenging times and ambiguity, and we all regain and the markets regain soon. And on this note, Hina, thank you so much for sharing your valuable insights with our viewers. I'm sure this session they found was really interesting and very insightful.
Thank you, Samta.
Well, that's all on Value Talk today. Join us on this exciting journey of live streaming network on financial and stock market news. Till then, keep watching Kalkine TV.